It is important to note that consolidation is not the same as aggregation. This can be illustrated by looking at a set of accounts for a group of units, subsectors, or sectors. A consolidated set of accounts is produced by an aggregation of all flows and stock positions within the GFS and PSDS framework, and then the elimination, in principle, of all flows and stock positions that represent relationships among the units or entities being consolidated. In other words, consolidation eliminates double counting. If we combine two units and there is an economic flow or debtor-creditor relationship between these two units, this flow or stock position appears in the accounts of both units. Consolidation involves removing this flow or stock position from the accounts of both units, thereby eliminating the double counting. Let's consider an example. If a social security fund owns a bond issued by the central government, and the data for the two units are being consolidated, then the stock positions of bonds held as financial assets and liabilities of the consolidated unit, say general government, are reported as zero. In other words, as if the bond position between these two units did not exist when they are combined. The consolidated general government position, therefore, shows only the bonds issued to holders outside the general government sector. The interest transactions related to this bond are also consolidated, so that the interest revenue and expense of the consolidated account exclude the interest paid by the debtor general government unit to the creditor general government unit. GFS and PSDS for the general government and public sector and their respective subsectors should be compiled and disseminated on a consolidated basis. We must distinguish between aggregated and consolidated statistics. Aggregated statistics mean the debt statistics, or GFS, for separate public sector units are added. But reciprocal stock positions or flows among the units being combined have not been eliminated. We must also not confuse consolidation with the calculation of net debt. Net debt is calculated as gross debt of a unit minus financial assets corresponding to the debt instruments of the same unit. This is not the same as the elimination of debtor-creditor relationships among different units to present them as if they are one unit. The concept of consolidation. This is a method of presenting statistics for a set of units or entities as if they constituted a single unit by eliminating all flows and debtor-creditor stock positions among the units or entities being combined. We always perform intra-sectoral consolidation before inter-sectoral consolidation. However, one should always keep practicality in mind. The resources devoted to consolidation and the level of detail applied in consolidation should be in direct proportion to their fiscal significance. In other words, will it make a difference?